The time period assumption assumes that the economic life of a business can be divided into artificial time periods. Accounting time periods are generally a month, a quarter, or a year. The accounting time period of 1 year in length is referred to as a fiscal year. The revenue recognition principle dictates that revenue be recognized in the accounting period in which it is earned. In a service business, revenue is considered to be earned at the time the service is performed. The practice of expense recognition is referred to as the matching principle. The matching principle dictates that efforts or expenses be matched with accomplishments or revenues. After the economic life of a business has been divided into artificial time periods, the revenue recognition and matching principles can be applied. The interrelationship among these elements is shown here. Under accrual basis accounting, transactions that change a company's financial statements are recorded in the periods in which the events occur. The revenue recognition and matching principles are used under the accrual basis. Under cash basis accounting, revenue is recorded when cash is received, and expenses are recorded when cash is paid. Generally accepted accounting principles require accrual basis accounting. Under a cash basis accounting system, revenue is recognized when cash is received. Expenses are recognized only when cash is paid. Here we see that using cash basis accounting measures can result in misleading financial information because income would be misstated for both years. Adjusting entries are needed to ensure that the revenue recognition and matching principles are followed. Adjusting entries are required each time financial statements are prepared. Adjusting entries can be classified as deferrals or accruals. Prepaid expenses are expenses paid in cash and recorded as assets before they are used or consumed. Prepaid expenses expire with the passage of time or through use and consumption. An asset-expense account relationship exists with prepaid expenses. Prior to adjustment, assets are overstated and expenses are understated. The adjusting entry results in a debit to an expense account and a credit to an asset account. Examples of prepaid expenses include supplies, insurance, and depreciation. Recall from Chapter 3 that Sierra Corporation purchased advertising supplies costing $2,500 on October 5th. Advertising supplies shows a balance of $2,500 in the October 31st trial balance. An inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. Thus, the cost of supplies used is $1,500, and the adjustment shown here is made. A review of Sierra Corporation's insurance policy prompts the adjustment for insurance shown here. Depreciation is the allocation of the cost of an asset to expense over its useful life in a rational and systematic manner. The purchase of equipment or a building is viewed as a long-term prepayment of services and therefore is allocated in the same manner as other prepaid expenses. Depreciation is an estimate rather than a factual measurement of the cost that has expired. In recording depreciation, depreciation expense is debited and a contra-asset account, accumulated depreciation, is credited. In the balance sheet, accumulated depreciation is offset against the asset account. The difference between the cost of any depreciable asset and its related accumulated depreciation is referred to as the book value of the asset. The adjusting entry to record depreciation for Sierra Corporation Agency's office equipment is shown here. Unearned revenues are revenues received and recorded as liabilities before they are earned. Unearned revenues are subsequently earned by rendering a service to a customer. A liability revenue account relationship exists with unearned revenues. Prior to adjustment, liabilities are overstated and revenues are understated. The adjusting entry results in a debit to a liability account and a credit to a revenue account. Examples of unearned revenues include rent, magazine subscriptions, and customer deposits for future services. The adjustment for Sierra Corporation's unearned revenues is shown here. Accruals may be for accrued revenues, to reflect revenues earned, but not yet received in cash or recorded. Or, accruals may be for accrued expenses, to reflect expenses incurred, but not yet paid in cash or recorded. Accrued revenues may accumulate with the passing of time or through services performed but not billed or collected. An asset revenue account relationship exists with accrued revenues. Prior to adjustment, assets and revenues are understated. The adjusting entry requires a debit to an asset account and a credit to a revenue account. An adjustment for Sierra Corporation's recognition of accrued revenues is shown here. Accrued expenses are expenses incurred but not paid yet. A liability expense account relationship exists. Prior to adjustment, liabilities and expenses are understated. The adjusting entry results in a debit to an expense account and a credit to a liability account. An adjustment for Sierra Corporation's recognition of accrued interest is shown here. An adjustment for accrued salaries is shown here. Check your understanding of the 4 basic types of adjusting entries by completing this summary. The trial balance is the starting place for adjusting entries. An adjusted trial balance is prepared after all adjusting entries have been journalized and posted. Its purpose is to prove the equality of the total debit and credit balances in the ledger after all adjustments have been made. Financial statements can be prepared directly from the adjusted trial balance. The purpose of the adjusted trial balance is to prove the equality of the total debit balances and total credit balances in the ledger after the adjusting entries have been made. Here is an example of an adjusted trial balance. The income statement is prepared from the revenue and expense accounts. The retained earnings statement is derived from the retained earnings account, dividends, and net income. The balance sheet is prepared from the asset, liability, and equity accounts. The retained earnings balance comes from the retained earnings statement. Financial statements are prepared from the adjusted trial balance. The income statement must be prepared first then the retained earnings statement, and finally the balance sheet. The statement of cash flows reports a form of cash basis income referred to as net cash provided by operating activities. Net income and net cash provided by operating activities often differ. The difference for Sierra is $2,840. The specific causes of this difference are shown here. Quality of earnings is greatly affected when a company manages earnings to meet targeted earnings. A company with a high quality of earnings provides full and transparent information that will not confuse or mislead users of the financial statements. Closing entries transfer the temporary or nominal account balances to the permanent stockholders' equity account, retained earnings. Revenue accounts, expense accounts, and dividends are all temporary accounts. All revenue and expense accounts are closed to income summary. Income summary and dividends are then closed to retained earnings. The steps required in the accounting cycle are: analyze business transactions, journalize the transactions, post to ledger accounts, prepare a trial balance, journalize and post adjusting entries, deferrals, and accruals, prepare an adjusted trial balance, prepare financial statements, income statement, retained earnings statement, and balance sheet, journalize and post closing entries, and finally, prepare a post-closing trial balance.